Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be doing a stock analysis on Cracker Barrel, ticker symbol CBRL. Alright, so for today's agenda, it's pretty full. I'm going to give a brief business description. We're going to look at the fundamentals and financials of Cracker Barrel. We're going to look at the 2021 Q3 results that were released today. We're going to look at the shares outstanding. We're going to look at dividend information, growth happening organically, the share price history over the last several years, and then finally I'm going to give my thoughts on a price target on Cracker Barrel. If you're new to my channel, I do stock analysis and personal finance topics, so if you like this type of content, please consider subscribing. Also, please hit that like button at any point. It really helps me out with the YouTube algorithm. Now, back to the content. Alright, so we've all been to Cracker Barrel. You walk up, there's a big front porch, there's rocking chairs, there's checkers. As you're waiting for your meal, or if there's a wait, you can sit out there. You can just relax, like you're you're just back at home, sitting on the front porch, waiting for a home cooked meal. They'll call you up to your table. You go up there. You walk through a store on the way in, and there's all these sorts of things that are kitschy. Some of them are kids. Some of them are very home style stuff, but you're walking through there, you see some things, but you're really focused on, you're hungry, you're going to the food. So you sit down, you got good old sweet tea, you got your chicken fried steak, you got fried chicken. I mean, you got all the home cookings. You got your mashed potatoes, you got your green beans, you got corn, you got literally anything. You got your biscuits, you got everything there. It's just home cooking at its finest. And just when you're satisfied, you eat your dessert, you're walking out, you're about to pay, and your little kid wants to go get some more something from the store, a piece of candy or some licorice, or your wife finds something really cute that she wants to wear. I mean, it's a cool business model. It's really good food. Really gets you on that walking through the country store part area as you're coming out. But as we'll talk about later, there are some, in my opinion, there are some growth concerns. But in terms of a business model, it's fairly solid. And just anecdotally, I think that food's good. All right, enough about me talking about food. Let's talk about the fundamentals. Let's look at their financials. So if we look from 2013 to the 2019 into the fiscal year 2019, we can see the reason 2020 they actually had a decrease between 2013 and 2020. But let's look at the 2019 numbers. We can see there was a $400 million increase in total revenue between 2013 and 2019. If you look at the years in terms of growth, it's been fairly low, in the low single digits. Looking at gross profit, it's again ticked up there along with the increase in revenue, and their gross margin has relatively stayed fairly flat, but it has increased by a couple percentage points as the years have gone on. If we look at their EBITDA margin, it's increased throughout the years, although it's decent. They had a pretty big hit in their EBITDA margin in 2020, but that's probably due to the pandemic. If we look at their net income, there was a slight decrease in 2019 compared to their 2018 numbers, but all in all, it looks like there was a fairly good net income margin for their business model. Again, if we're comparing them to a tech stock or an oil company, these aren't necessarily good margins, but for the type of restaurant that they are, the margins are fairly solid. But thing to note here is not a lot of growth happening in terms of total revenue, low single digits. If we look at the fundamentals of cash flow, free cash flow here, we can see that from in 2019 they had a free cash flow of $225 million. In 2018, that cash flow is $179 million. So you can see that's about a $45 million increase in free cash flow. But in 2017, they actually had a 210. So they went from 210 to 179, back up to 225. So in terms of free cash flow, they're a little up and down here, and I don't really like to see that. I like to see it steadily increasing. So again, from their 2017 to their 2019, they went from 210 to $225 million in free cash flow. Not a big jump there. Anyways, again, like I said earlier, not a lot of growth in this aspect. Cracker Barrel released their Q3 2021 earnings this morning. They came in at $1.41 EPS diluted. The analyst anticipated 24 cents, so they beat pretty largely by 387%, by $1.17 a share. On the revenue side, they did beat quite substantially. I think substantially, 5% beat is pretty good. And so they had revenues of $713.4 million for the quarter, and the analysts were estimating about $680 million.63. So a pretty good overall beat here. Now let's dive into the press release and see what else was announced. If you like my videos so far, please hit that thumbs up button. It helps me out a lot, helps get the video out to other viewers. So thanks so much for watching thus far. Please like it. Back to the content. All right, so looking through the press release, we can see right up top, declares quarterly dividend. I've already read this, so I know it's $1. Previous was at $1.30, and it's been 3 quarters since they've actually issued a dividend. I had a pre-recorded session. I'm throwing all that out now before I compile the video because I did not think they were going to do that, and if they did, I thought they were going to reinstate around 65 cents. I want to read a little bit further into this. Again, if we go down here, we see revenue is at $713 million. One thing I wanted to show was that $713 million, while it was a big beat on the number from last year at $433, it was not an increase from their May of 2019. So it still is about $20 million off from where they were back in 2019. But overall, I think that's fairly good, and it shows that the recovery is fairly close to back to where it was pre-pandemic. And if they did have some growth in the last year in terms of opening new stores, I think they've definitely have a better quarter for Q4 coming up. So it's positive to see that they reinstated that dividend, and we'll see what else. So coming down here, it's going to be payable on August 6th to shareholders that are recorded on the 16th. And one thing we just want to say here, the pace of our sales and margin recovery in the quarter exceeded expectations, and they blew them away as we welcome guests back into our dining and our business remains strong. I'm pleased the way our teams handled this, and ongoing recovers brings us back to that 2019 sales level. I'm confident our solid execution, unique brand, strategic initiative, and long-term shareholder value. So again, look at most of these numbers, comparables, they're still relatively down. It looks like the retail sales are up versus comparables. So it looks like they're making more money on the retail side than it was prior. Let's see if there's any more dividend information. I'm pleased that our strong quarter performance enables us to restart dividend program with a history of prudent capital management allocation. As it always does, the board will evaluate our capital structure and allocation priorities as we move past the pandemic into our next fiscal year. So let's see, Q4 outlook, total revenue is approximately flat to fiscal 2019. So if we go back here, look at 2019, let's see, 787. So they're estimating that they're going to have around 787 million for Q4. Continue substantial operating margin above 2021. If we go here, operating margin, let's see. Okay, not a big deal there. Commodity inflation, approximately 5. Next piece is 3.5. Capital expenditures of approximately 25 million. That's interesting because if we go over to cash flows and we look at their quarterly, you can see their cash flow down here. Where is it? Cash from operations, capital expenditures. We look at CapEx. Okay, that's pretty much in line with what they were doing previously, so nothing big there. 25 million, and the effective tax rate 11 to 12%. Additionally, the company now expects to repay a total of 500 million in its third-party borrowing. So they're going to pay down some debt, including up to 165 million in the Q4. So they're going to look like they're going to start paying down some debt here. And that's it for all the updates on the actual press release. So overall, really good quarter for them. I'm actually going to have to scrap my dividend section. So if there's any reference to dividends in the future, especially on the summary section, just ignore it. Essentially, they've done fairly well. This does not change any of my opinions on of it as a long-term investment, but I think they will need to reevaluate the dividend as they move into further quarters. If they see any declines or pullbacks in sales, then it sounded pretty much like down here that they were going to remain flexible. So if their earnings per share do go down, it sounds like they're going to be flexible on that. And their payout ratio, one thing I am interested here is their payout ratio. If they're doing a $1.41 a share and they're doing $1, so what is that just off top? 1/41, about 71%. So that's pretty high for a payout ratio. If I look at statement of cash flows, I think. No, where are we at here? Okay. Look at their payout ratio on their dividends in previous years. We can see that, yeah, 60. So they did have in November, you can see their earnings per share in November of 2018 was $1.80, and their payout was $1.30. So that put them in a 74% payout ratio. At 70%, I feel like that's fairly high. That's not a safe number for me. So again, I'll just say that be careful if you are going after this for a dividend. If they do have any issues with their earnings per share up here, I think at this point that dollar is not set. And then again, to their point, they're going to be flexible on how much they're putting in. So really good quarter. Let's move on. All right, next up, let's look at shares outstanding. Now, shares outstanding is important because this is a way companies dilute you if they're issuing more and more shares. The good thing we see here with Cracker Barrel is, while it isn't a huge decrease in shares, they did have a buyback right at the beginning of 2020 that decreased their number of shares outstanding by about 1%. So that was good for existing shareholders. However, the pandemic caused a pretty big suppression, and there was a huge dip right around the time at which they were purchasing stock. But again, the stock has since risen up, and we'll look a little bit more into that in a further slide. All right, now on to growth. If we look at Cracker Barrel, the geographic distribution here, you can see that they're very heavily situated on the East Coast. They have some major locations in some of the major metropolitan areas. If you look at a big state in Florida, you see that they're all along the coastal areas. Look in Texas, if you look down the center there, you can draw a line. That's the I-35 corridor, where a lot of major cities are. And if you look in the bottom right of it, that's kind of Houston. So they're located on the major metros in Texas as well. If you look in California, again, it looks like they're in all the major metros there. And then a little weak on the north side, but I think they have a lot of opportunity up in the northwest. But we'll see. But again, they've really filled out everything on the East Coast. So if they are going to expand, it either needs to be international, which I don't know if their business model really supports that. But really their growth is going to be on the West Coast, but it doesn't seem like they're growing all that fast. One of the things about their growth is that they've been averaging about 5 to 10 new stores per year since 2015, and that's about a less than 1% growth in their existing stores based on the same period. So again, they're not growing rapidly. It's very small growth in terms of the percentage. Again, low single digits here. So keep that in mind as you're purchasing the stock. It looks like they're producing solid income, but again, low on the growth side. All right, moving into the stock price history. If you look at Cracker Barrel over the last 5 years, you can see their stock has really varied between 130, low 135 back in the end of 2016, and it's basically hovered in between 150 and 160, 170 for the last 5 years. Currently, it's trading at 160, which is a little bit lower than its the last couple months, but it's right there where it was pre-pandemic. If you look at its fundamentals, it's again hasn't fully recovered yet, but a lot of the companies such as Cracker Barrel, their stock prices have recovered back to pre-pandemic levels or close to pre-pandemic levels, but they're not. Their financials don't nearly look the same. So I think it's going to be a couple more quarters. Anecdotally, seems like demand is back. You go to a restaurant. I think the biggest thing that people are struggling with right now is finding labor to work these restaurants. So that may be a headwind for not just Cracker Barrel, but again, all restaurants in the type of industry. So keep that in mind. So Cracker Barrel is good food, good experience, good ambiance when you go in there. Their fundamentals have been fairly solid leading up to the pandemic. Like most restaurants, their 2020 numbers were terrible. If we look at the shares outstanding, they did buy back some shares prior to, as the pandemic was starting. That program has been suspended, as well as their dividend was suspended shortly after. And the dividend, I think they will give a partial restore in the next couple quarters because it looks like they're on pace to get somewhere like that. But I don't believe they're going to restore their dividend back to the $1.30. So if you are expecting that, my opinion is it's going to be probably closer to 9 months to a year before that is solid enough for them to feel confident. I don't believe that's not a negative thing on the restaurant industry. Go to restaurants, they're completely packed, but they did take a big hit. And so hopefully we see that kind of shift back and things go to business as usual on the amount of revenue that these businesses are being able to generate. We look at their share price history, where they're trading at about $160 a share. That's about where they were pre-pandemic. Looking at their fundamentals, look at the financials of 2020. They're nowhere near where they were back in 2020 or 2019. So I think you really got to approach this with some caution. Do I think it's trading at a fair value? Yes, but it's really cooking in a full recovery. Do I think a full recovery is going to happen? Yes, but there is that risk of, again, the numbers it's still trading at a higher P/E price to earnings than it was prior to the pandemic, and that's because the earnings just aren't there yet. Now, and I keep saying yet, but what does that really mean? I don't think there's much left on the capital appreciation side for Cracker Barrel at this point. So with all that being said, I'm going to be pretty lame and just say my price target is at 160, really where they're trading at right now. Again, I don't think there's much room to run here. Do I think they could have some short-term ups? But I think it's going to take several more quarters before they really deserve to be trading at a higher price. Now, I think there is an appropriate price to buy in at, and that could be sitting around 140. So again, that's just one thing that I'll throw out there if it did go into 140, and granted things were exactly how they are right now, demand's the same, recovery's still happening, there's no scare on the coronavirus factors, 140 is probably a good buy-in. That gives you some good upside as well as some good downside protection as well. All right, please consider subscribing if you like this video. It helps me out so much. Also, hit that thumbs up button. It's awesome. Do it. Please hit that thumbs up button. It helps me out a lot. Now, thanks so much for watching. Frank Finance, out.